Today, we're going to be working on populating the financial statements and then talking about the closing entries. I told you I'd take those pictures. If you could find yourself and just put your first name and last initial. I'll put a pen on there so you can use a pen. I know when I'm teaching you want to use a pencil, but. Hey, you're right. The same handout from Tuesday. We have more to go on it. It's handout number 4. If anybody needs a copy, I have one remaining. Okay, so what we're gonna be doing is we're gonna be taking things from the adjusted column and populating our financial statements. Right, so here we're doing the income statement. And the income statement asks for computer services revenue. So we're gonna find computer services revenue. We're gonna take it from the adjusted column. That's 31,284. These would be page 6 on your notes where you're populating it. And then we're gonna record the expenses. So we have depreciation expense for office equipment, computer equipment, wages expense, insurance expense, rent expense, computer supplies expense, advertising expense, mileage expense, miscellaneous expenses, and then computer expense repairs 1305. So you'll want to total that up, bless you. Oh. Okay, so do we get total expenses? Anybody have a number? And that's also what I got, so good. And so our net income here, the 31,284 minus the 16,824 gives us 14,460. And all I did was take these numbers directly from the adjusted trial balance and input them into the income statement. Now, remember, part of the income statement flows into our stockholders' equity, so that's the statement we're gonna use next. So since this company was started on October 1, our retained earnings is 0, but we're gonna add net income. Now, we would deduct it if it was a net loss. Just so you know, if you see that, and you can have that, 14,460. But we have to subtract out any dividends. And so those dividends are 7,100. Fingers are a little off there, I'm sorry. And so our retained earnings at the end is 7,360. What I'd like you to do, and I'll leave this up, but you have it available on yours if you were here, if you weren't. Now I'd like, like you to populate the balance sheet. And so this is just from what we did Tuesday. And for those of you that weren't here, you can fill this out on your adjusted, and then you're gonna take those numbers and you're gonna put them, you're gonna work together with the people around you to put it into your balance sheet. The assets will go here, the liabilities and equity there. And if you have any questions, please let me know. I'm gonna give you guys like 10 or 15 minutes to do this. You guys can work in groups, talk to each other, and populate that balance sheet. You can use your notes. You can use the book. Anybody else needs me to move the pictures around, let me know. relatively straightforward, right? Our trial balance is categorized, right? Our trial balance is categorized, you have assets, assets paid, petty accounts payable, right, that's a liability. Then you have wages payable, also a liability. And you have one computer services, right, that's also a liability. Then you get into your equity. If you already know computer services with revenue and expenses are below that, so we're not gonna include that. We need to include everything above here. In the research. Hello, 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 hello. Okay, so I'm just gonna start the assets one. Yeah, I will. I just move on to the next one and I'll kind of go through and do them all and I'll explain them. Don't worry. And I know you're gonna make mistakes in this process. Don't worry about that. You know, that's the kind of thing that you're learning. You're giving it a try. Hello, Mr. Moret. How may I help you? It's just to kind of keep the other ones that you can say, okay, these are the totals from here. So remember we talked about book value. So office equipment, less its depreciation, is its book value. But essentially here, if you're totaling things up, you just put the total over in the other column there. So all these are is this netted together and that netted together.
I have a question. Does it matter exactly like how we format it? Because I did my balance sheet.
So
Debits.
I wouldn't hold it against you, but it like officially it does matter in terms of the layout of it. Yeah. Yeah. I'm not having you guys learn the nitty gritty of putting accounting in an exactly way. Just know that like your assets here are supposed to be in kind of liquidation ability, right? So how quickly can I turn this stuff into cash? And so that's why you'll see your long-term assets after your current assets. The reason that I put it in this column is essentially these numbers didn't have any adjustment on here. And so here, these numbers are totaled together to go here and totaled together to go here. But I'll go over that. Okay, I'll give you a couple minutes to finish up. I put the answers up there now, and then I'll walk you through them afterwards. Okay, so there were a few questions mostly about the format of it, right? And so I set these up for you so that you don't have to try to remember the format and the structure and all the little nitty picky details about accounting. Now, if you were going to be preparing these financial statements, of course, it would be a different story. And one thing that you'll want to note is that the balance sheet is the only one that exists just for one day. And so you see business solutions, the balance sheet, and then December 31st, 2020. So they're telling you, as of this date, this is our best representation of what we have on our balance sheet as of that date. So this is the book value of the company's assets, liabilities, and equity. Okay. So you start, and the way the preparation works is that you list your most liquid assets first. And in this case, when they're talking about liquidity, they're talking about how quickly can I turn something into cash. So cash would be first, accounts receivable would be second, supplies, prepaids, and then you get into your long-term liabilities or your non-current liabilities. Okay. Now, why did I put a column in there? Because in general, when you net things together, you want to do that separately so that people can see what's going on, and then just put the one number over. All right. Now, I pulled up a couple financial statements. For the most part, this is the right set of rules. But if we look in practice, what they'll do is they say property, plant, and equipment net. Right? So they just have that one number. We would just have office equipment net if it was on ours. But if we want to find the details on this, you have to go to their notes. Sometimes it takes a while. So here they've got their inventories, but here they've got their property, plant and equipment. And so what we did on the front was essentially, we put the, if we were to do it, the 28, 623 and the 15 just out there so they can see them. They only put it in this one number as 12,680. So no, format wise, this is the correct format. And you'll notice that each column, when you put it in there, the first column has a dollar sign. So you see a dollar sign here. You don't see a dollar sign everywhere else. Also, you put in the value the way that it's supposed to be reflected. So in this case, you're adding a positive and a negative number. And so that's how you can tell. Now, sometimes, and I don't know if this one's going to do that, if it says less accumulated depreciation, technically you're not supposed to put the parentheses in there, because parentheses, if you have less a negative, that would be a positive add. So I'm a stickler on financial statements when they have that type of stuff, but as you can see, it's not always a perfect world. So that was, I believe, Apple. No, that was Caterpillar. And so this is Apple. And you can see Apple separates theirs out by current assets and non-current assets, which you can do as well to give you the total assets. Now, when you get to a total asset category or a total category, you put the dollar sign in and then you underline twice. Okay. I'm not going to test you on these formal rules, but when you get out there in the real world, this is kind of what how they describe it. So here, like when you read this line, adjustment for net gains or losses, you can tell, okay, I've got a gain here because it's in parentheses. This was a gain. This here was a loss. Right? Y'all see that? So we try to give as much information on there. And when we total things up, we usually put it in a different column. But on large financial statements where you're comparing 3 years, they usually just cram it into one column. Okay. So that's what a balance sheet in good form would look like. And so if I ever say in good form, that's what it means. Any questions about the numbers and where they came from? Yes, Josh. Right, so that comes from here. And what you have to recognize is that this retained earnings is as of the beginning of the period. We didn't make any adjustments to it. But we go ahead and we make the adjustments to it here. And that's why we also don't include the dividends account on here. And we're going to talk about why when we talk about preparing closing entries. But that's an excellent question. Also, I wanted to let you know, there's a couple students coming by at 5:15 for help. If anybody needs help, then I think this room is open. We'll just come back in here and throw some stuff up on the boards if anybody wants to come in and learn at some additional. I apologize for being so late, but I teach at 2:30 and then at 4 o'clock to 5:15. So that's when it would be if you want some additional help. If you're not going to be here on campus, but you want to try to Zoom in, I'll try to put a Zoom link up for you guys if you want to ask some questions. Now, again, I don't know what the students are going to ask. So it'll just be whatever questions you're throwing at me. I don't have anything prepared. Okay. All right, any questions on the balance sheet? Okay, so now we're going to get into what's called closing entries. And closing entries So closing entries eliminate the balances in temporary accounts. And so for our purposes, we're going to be thinking about the revenue and expense accounts and dividends. For revenue and expense, they get closed into the income summary account. Then the income summary account gets closed to retained earnings. Dividends also gets closed to retained earnings. So you'll just want to remember that as we have revenue accounts that our balance is on the credit side, right? And that expenses have that flipped. And so when we close these out, what you want to do is eliminate that balance in that account. Now, I'll give you a minute to finish writing there. So first step, close revenue to income summary, and you'll debit revenue, and you're going to credit income summary. The second step is to close the expense to income summary, and you're going to debit income summary, and you're going to credit expense. Make a little note each account. The third would be close income summary to retained earnings. And so generally speaking, if net income is positive, then it would be debit income summary. For the net income or revenue minus the expenses. right? That's the net amount. And then the fourth step, close dividends to retained earnings. So this would be debit retained earnings, credit dividends. So in this one, we had the balance of 31,284. I might have fudged these last ones, but I think I'm right on the 31, right? That was our income. Okay. And then we had expenses that were 16,824. Too many numbers that are similar. Okay. So at the end, we have 16,824, and I'm putting all of them together. And their ending balance would be 31,284. And what we essentially have to do is get this to be zero. So our closing entry is going to be 31,284. Here, our closing will be 16,824. And that'll leave this account with no balance. Okay. So hopefully that gave you enough room, bless you, to put all those notes down, and we're going to flip to the page and we're actually going to do the entries now. So we want to close computer service revenues. $31,284. And we're going to close it to income summary. $31,284. So now we have our income summary account. And now we've debited it for 31,284, and we're going to end up crediting it for 16,824, excuse me. And so what's going to happen is it's going to have a balance of 14,460. I think that was our net income. Is that right? Yep, 14,460. And so what we're going to have to do in this last entry is close it out. And so this entry will also have a zero balance. Okay, so next we're going to do the expenses. And so, did I do that backwards? I did that backwards. Sorry, I did that backwards, and then your closing would be over here. So your debit here is going to be to income summary. And it's going to be for the 16,824. And then we're going to have a list of all the expense accounts. Don't worry, I'll go back there. And I'll give you plenty of time to write. Okay, so we've closed the revenue account. We've closed the expense account. Now we have to close the income summary account. And so this would be a debit to income summary and a credit to retained earnings. Now you're looking at the difference, which should be your net income between the two accounts. And so you get 14,460. And now all three accounts have a zero balance. Okay. And then the last thing we have to do is we have to close out the dividends account. And so we're going to debit retained earnings. And we're going to credit dividends. And that was 7,100. So those are your closing entries. And then what you have is your post-closing trial balance, which essentially should take all of the things from your closing trial balance all the way down to just before retained earnings. Alrighty then. And then retained earnings will have its new balance of 7,360. And so when we add these up, and please check the math on it, 85.10. Okay, any questions? Okay, for the most part, I'm just gonna kind of talk through the accounting cycle because it's pretty much what we've done so far. And if you're more of a visual learner, take it just a look at the picture that they have in the book, but it's pretty straightforward. It's all the stuff that we've been doing. And it's kind of a circular process, but we're going to analyze activities and journalize transactions. So all that is here's what we're doing as a business. We're recording revenues, we're recording expenses, And so all we're doing is just journalizing those activities. Now, this is something that we kind of ignore in the class because it's mostly done by computers now, and we don't do it anymore, but you'll see in the book that it's posted to the general ledger or just ledger. And basically that's just once the journal entries happen, it used to be kind of a manual process in accounting to go back and say, okay, now we're going to post them to the specific accounts. I don't have you guys do that because it is just an exercise in boredom, but essentially it would be going in and putting all the transactions into these T accounts as they occurred from the journal, and computers do that now, right? But that puts it into the ledger for you. All right, and then we prepare an unadjusted trial balance. And then we analyze adjusting activities and prepare adjusting entries. Journalize the adjusting entries. Prepare an adjusted trial balance. And so these are all the things that we've done with this problem that we walk through in chapter 4, and it brings together all of the activities from before it as well. So we had posting some transactions, we focused on the adjustments, how to prepare them, how to analyze them. Then you prepare financial statements from the adjusted trial balance. Analyze closing entries. And prepare closing entries. I just put journalize entries and post. I added and post up to here, but again, computer does all this for us now, so we don't really think about that too much. And then you prepare post-closing trial balance. Good. Excellent. All right. So now we have just the last little part, and in all the chapters, they give you some sort of analysis at the end with some ratios. And I haven't really focused on them before because I don't think we really had a big picture of what is going on. And it's hard to analyze, but all those ratios are fairly valuable. And the reason that they're important is that it helps us what they do is they help us assess the company's performance versus other companies. Now, I have Apple and Caterpillar pulled up, and for the most part, they follow the same set of GAAP rules, but they're in very different industries. So the comparability is going to be a little different between companies when they're in different industries, but you should be able to look at a company and say, okay, here are their ratios that I am concerned about. And I want to look at them and compare them. So you could take Apple and theoretically compare it to Samsung, who's a similar competitor. And I apologize, I don't know if I know Samsung produces other things that Apple doesn't, so it would be hard to compare them directly, but keeping that kind of thing in mind, that's the type of thing that the ratios let us do. And they also let us compare the company year over year. And so for a company like Apple, what you want to be able to do and look at is to say, are these ratios getting better? Or are they getting worse? Are they the same, et cetera? But they really help us assess the company performance. All right. And then we have liquidity here. So big picture, what does liquidity mean? Can the company pay its bills? And these are the liabilities that will come due in the future. Most of the time, liquidity is focused on the company's ability to pay short-term or current debts / liabilities within the next operating period. And this is usually a year, remember? So if you look up the definition of liquidity, it says, hey, we're going to look at just your short-term loans. But sometimes when people say the word liquidity, they can mean short and long-term. Can you pay your bills short and long-term? But truly, definitionally, liquidity is in the short term. Working capital is a measure that allows investors to assess ability to pay current liabilities with current assets. And so working capital equals current assets minus current liabilities. The current ratio is a numerical measure comparing the current assets and liabilities. And again, it assesses the ability to pay current liabilities with current assets. And so the current ratio would be your current assets divided by your current liabilities. And then the acid test ratio moves inventory from the current assets to evaluation issues. And so you have current assets minus inventory divided by current liabilities. And what does current mean? Keep in mind, remember that we expect to use it within one operating cycle of the company, usually 12 months. And so assets expected to be used up to produce income, liabilities are expected to be paid by the company from their operations. All right, I'm going to jump in and just do a quick example 3. I'll leave those up so you can keep writing. Okay, calculate the firm's working capital and current ratio under each situation. So the first situation, management doesn't pay 3770 of AP before year end. And so our working capital equals 12,801 minus 7510. And so that equals 5,291. Current ratio take 12,801 and you divide it by 7,510. And that equals 1.7. And I usually just say 2.1. So that means for so I like to tell you what it means. It means that for every dollar of current liabilities, you have $1.7 of current assets. Okay. Management pays 3770 on AP. Before year end. And so essentially your current assets $12,801 minus 3,770 because we used cash. And so now we end up with 9,031 in current assets. Our current liabilities drop also. And so we had 7,510 minus 3,770. And I get 3,740, is that right? And if we remember on algebra, if we remove the same number from both, then our working capital does not change. And we'll see that now. We have 9,031 current assets minus that 3,740. Just make sure. And so we still end up with 5,291. But what does change is your current ratio. Here, and so you have 9,031, and you're going to divide it by 3,740. And so now that's 2.4 to 1. Now this says, assume that they had negotiated a short-term bank loan of 5,000 that can be drawn down either before or after the end of the year. Calculate the working capital and current ratio at end of year under each situation. So again, this is pretty straightforward. You know, you're just going to have, okay, that can be drawn down. So I'm assuming that means when they say drawn down can be paid off or drawn out. Let's see. Sometimes the language is fun. And so here I'm going to go with paid off. And so for your working capital, there's going to be no change. So if we had 12,801 minus the 5,000 because we had to pay cash. That would be 7,801. And then we'd have 7,510 minus 5,000. Short-term loan paid off. And that equals 2,510. So 7,801 minus 2,510 equals 5,291. Now this would change your current ratio. And so we have 7,801. We divide that by 2,510. And we end up with 3.2 to 1. Right on time. And that is it for class today. If you have any questions, please ask. Remember, this gets uploaded and the video gets uploaded too. And I will see you guys on Tuesday. Have a great weekend. If you're coming tonight, my office is right down the hall, 229. We'll start there. If there's enough people, then we'll just come back into this classroom.